My dear students, welcome back to our channel. Students, in this video I am explaining JNTU Hyderabad MBA first semester, subject financial reporting and analysis, important short questions and answers. Let's start quick revision. First unit, first important short question is functions of accounting. Accounting has several key functions. 1. Recording transactions. This involves noting down all financial activities, like sales and purchases. For example, if you buy a computer for your business, you record it in your books. 2. Classifying data, organizing transactions into categories, such as assets, liabilities, or expenses. 3. Summarizing information, preparing reports, like income statements and balance sheets, to show the business's financial health. 4. Analyzing data, understanding financial trends and making decisions based on that info, like how much profit the business is making. In short, accounting helps businesses track, organize, and understand their finances. Next important short question is explain any 3 accounting conventions. Here are 3 common accounting conventions. 1. Conservatism. This means being cautious when estimating profits. For example, if a business might lose money in the future, it records that loss even before it happens, but doesn't count profits until they're sure. 2. Consistency. This means using the same accounting methods every year. For example, if a company uses a certain method to calculate depreciation, it should continue using that same method. 3. Accrual. This convention says that transactions are recorded when they happen, not when money is received or paid. For example, recording a sale when it happens, even if payment comes later. These conventions help make financial statements reliable and consistent. Next important short question is GAAP stands for Generally Accepted Accounting Principles. It's a set of rules and guidelines that businesses follow when preparing their financial statements. The goal is to make sure financial reports are consistent, clear, and reliable for investors, regulators, and other users. For example, GAAP requires companies to report their revenue when it is earned, not when they receive the payment. GAAP helps ensure fairness and transparency in financial reporting. By following these rules, companies can be trusted to provide accurate and comparable financial information. Next important short question is double entry system. The double entry system is a method of accounting where every transaction affects at least 2 accounts. Each transaction has 2 parts, a debit and a credit, ensuring the books stay balanced. For example, if a business buys inventory for $500, it would debit the inventory account, increases assets, and credit the cash account, decreases assets. This system helps prevent errors and keeps financial records accurate, as the total debits must always equal the total credits. It ensures the accounting equation, assets is equal to liabilities plus equity, stays in balance. Next, second unit. First important short question is, what is the difference between journal and ledger? Explain with examples. The journal and ledger are both important in accounting, but they serve different purposes. 1. Journal. It's the first place where all transactions are recorded in order, called journal entries. For example, if a business buys office supplies for $100, the journal entry would be debit office supplies $100, credit cash $100. 2. Ledger. After transactions are recorded in the journal, they are transferred to the ledger. It shows a summary of each account, like cash or office supplies. For example, the $100 office supplies transaction will appear in the office supplies account. In short, the journal records transactions, and the ledger organizes them by account. Next important short question is trial balance. A trial balance is a report that lists all the balances from the ledger accounts to check if the total debits equal total credits. It helps ensure that the accounting books are balanced. For example, if a business has cash $500, debit sales $500, credit, the trial balance will show debit $500, cash, credit $500, sales. If the total debits and credits match, the trial balance is correct. If they don't, there may be errors in the journal or ledger that need fixing. It's an important step before preparing financial statements. Next important short question is revenue. Expenditure refers to expenses that are incurred for the daily running of a business and provide benefits only in the short term. These expenses are not related to long-term assets. For example, paying for electricity, wages, or repairs to equipment are all revenue expenditures because they help the business operate but do not create long-lasting assets. In short, revenue expenditure is the cost of running a business day to day, and it is recorded as an expense on the income statement for that period. It does not add to the value of the business's assets. Next important short question is what are the possible reasons for keeping incomplete records? Explain any three. Incomplete records may be kept due to various reasons. Here are three common ones. 1. Lack of knowledge. Some small business owners may not understand proper accounting methods and keep only basic records, like cash receipts. For example, a small shop might only record sales, not expenses. 2. Cost issues. Maintaining complete records can be expensive, especially for small businesses. For example, hiring an accountant might not be affordable. 3. Limited resources. Smaller businesses may lack the staff or time to maintain full records. For example, a small restaurant may not have enough staff to track every transaction in detail. In short, incomplete records are often due to lack of knowledge, high costs, or limited resources. Next important short question is what are the features of incomplete records? Incomplete records have several features. 1. Limited transactions. Only a few transactions are recorded, like cash sales or receipts. For example, a small store may only record daily cash sales, not purchases or expenses. 2. No full system. There's no formal accounting system, and records might be kept in a simple book or even on scraps of paper. 3. Lack of detail. The records often lack details, such as dates, amounts, or descriptions of transactions. 4. Difficulty in accuracy. It's harder to get accurate financial reports or determine profit. In short, incomplete records are basic, disorganized, and missing important financial details. Next, third unit. First important short question is, valuation of assets is the process of determining the current value of a company's assets, such as property, machinery, or inventory. For example, if a business owns a machine bought for $10,000, its value might decrease over time due to wear and tear, and it may be valued at $7,000 after 5 years. The valuation helps businesses understand the true worth of their assets, which is important for financial reporting, selling, or securing loans. In short, asset valuation is about finding out how much an asset is currently worth. Next important short question is inventory valuation. Inventory valuation is the process of determining the value of the goods a business has in stock. This is important for calculating the cost of goods sold and determining profit. For example, if a shop has 100 shirts at $20 each, the inventory value would be $2,000. If the price changes or some items are sold, the inventory value will need to be updated. Common methods of inventory valuation include FIFO, first in first out, and LIFO, last in first out. In short, inventory valuation helps businesses know the worth of their stock, affecting profit and financial decisions. Next important short question is define goodwill. Goodwill is the value of a company's reputation, brand, customer relationships, and other intangible assets that make it more valuable than just its physical assets. For example, if a popular bakery is sold for $100,000, but the value of its equipment and property is only $70,000, the remaining $30,000 is the goodwill. This extra value comes from the bakery's loyal customers and strong brand. In short, goodwill represents the extra value a business has beyond its physical assets, based on its reputation and customer trust. Next important short question is valuation of goodwill. Valuation of goodwill is the process of determining the value of a company's goodwill, which is based on its reputation, brand, customer loyalty, and other intangible factors. For example, if a business is sold for $500,000 and the value of its assets, like buildings, equipment, etc., is $400,000, the goodwill would be $100,000. This extra $100,000 reflects the company's strong market position and customer trust. In short, goodwill valuation helps determine how much intangible factors, like reputation and customer base, add to the overall value of a business. Next important short question is depreciation. Depreciation is the process of allocating the cost of a long-term asset over its useful life. It reflects how the value of an asset decreases over time due to wear and tear, age, or obsolescence. For example, if a company buys a machine for $10,000 and it is expected to last for 5 years, the company might depreciate the machine by $2,000 each year. In short, depreciation helps businesses spread the cost of expensive assets over time, matching the expense with the income they help generate. Next important short question is written down method of depreciation. The written down method, also known as the reducing balance method, is a way to calculate depreciation where the asset's value is depreciated by a fixed percentage each year on its remaining value, not its original cost. For example, if a machine is bought for $10,000 and depreciates at 20% per year, the first year's depreciation would be 20% of $10,000, $2,000. The next year, depreciation is 20% of the remaining $8,000, $1,600, and so on. In short, the depreciation amount reduces each year as the asset's value decreases. Next important short question is super profits. Super profits refer to the profits a business earns above the normal expected or average profit. It's the extra amount of profit that a business makes due to its exceptional performance, competitive advantage, or unique resources. For example, if a business normally earns $50,000 in profit, but due to strong brand recognition, it earns $70,000, the super profit would be $20,000, $70,000 to $50,000. In short, super profits are the additional profits earned beyond what is expected, reflecting above-average success or competitive advantage in the market. Next, fourth unit. First important short question is FSA. FSA stands for Future Salary Appraisal. It is an estimation of how much a person's salary might increase over time based on performance, market conditions, or other factors. For example, if an employee's current salary is $40,000 and the company expects to give a 5% raise each year, the FSA might predict the employee will earn $42,000 the next year, $44,100 the following year, and so on. In short, FSA is a projection of future salary increases, helping businesses and employees plan for growth and financial decisions. Next important short question is working capital. Working capital is the money a business uses to manage its day-to-day operations. It is calculated by subtracting current liabilities, debts due soon, from current assets, resources the business can use in the short term, like cash, inventory, and accounts receivable. For example, if a company has $50,000 in current assets and $30,000 in current liabilities, the working capital would be $20,000, $50,000 to $30,000. In short, working capital helps businesses ensure they have enough funds to cover short-term expenses and stay operational. Next important short question is funds from operations. Funds from operations, FFO, refers to the cash a company generates from its core business activities, excluding non-operating items like investments or financing activities. It's often used by real estate companies to measure profitability. For example, if a company earns $100,000 in revenue, spends $60,000 on operating costs, and has $10,000 in depreciation, the FFO would be $50,000, $100,000 to $60,000. In short, FFO focuses on the cash generated from regular business operations, providing a clearer picture of financial health without including non-cash expenses or external factors. Next important short question is paid cost and unpaid costs. Paid costs are expenses that have already been paid by the business. For example, if a company pays $1,000 for office rent, it is a paid cost because the payment has been made. Unpaid costs are expenses that have been incurred but not yet paid. For example, if a company receives a bill for $500 in supplies but hasn't paid it yet, it is an unpaid cost. In short, paid costs are settled expenses, while unpaid costs are obligations the company still needs to pay. Both are important for managing a business's cash flow. Next important short question is what is funds flow in accounting? Funds flow in accounting refers to the movement of financial resources, funds, in and out of a business. It tracks how money is used and generated over a specific period, showing how funds are raised and spent. For example, if a company raises $10,000 through a loan and spends $5,000 on equipment, the funds flow statement would show an inflow of $10,000 and an outflow of $5,000. In short, funds flow helps businesses understand where their money is coming from and where it is going, aiding in financial planning and decision-making. Next important short question is distinguish between funds flow and cash flow. Funds flow and cash flow are both important in accounting but differ in focus. 1. Funds flow tracks the movement of financial resources, funds, over a period, showing how money is raised and spent. For example, raising funds from a loan or issuing shares is included. 2. Cash flow focuses on actual cash coming in and out of the business, including operating, investing, and financing activities. For example, paying cash for supplies or receiving cash from customers. In short, funds flow is broader, tracking all financial changes, while cash flow focuses specifically on cash transactions. Next, fifth unit. First important short question is liquidity. Liquidity refers to how easily a business can convert its assets into cash to meet short-term obligations. The more quickly an asset can be converted, the more liquid it is. For example, Cash is the most liquid asset because it is already in the form needed. On the other hand, property or equipment is less liquid because it takes time to sell them for cash. In short, liquidity helps a business ensure it can pay its bills and expenses without difficulty. High liquidity means more flexibility to handle short-term financial needs. Next important short question is leverage. Leverage in finance refers to using borrowed money, debt, to increase the potential return on investment. It allows a company to use other people's money to grow its business, but it also increases the risk. For example, if a company borrows $10,000 to invest in equipment and earns $15,000 from its use, the leverage has increased the return. However, if the business only earns $5,000, the company still must repay the $10,000 loan, increasing the financial risk. In short, leverage can amplify profits, but also magnifies losses, depending on how the borrowed funds are used. Next important short question is solvency and profitability ratios. Solvency ratios measure a company's ability to meet long-term debts. A common solvency ratio is the debt-to-equity ratio, which compares total debt to shareholder equity. For example, if a company has $100,000 in debt and $50,000 in equity, the ratio is to 1, meaning it has more debt than equity. Profitability ratios assess a company's ability to generate profit. For example, the net profit margin measures how much profit is made from sales. If a business earns $10,000 in sales and has $2,000 in profit, the net profit margin is 20%. In short, solvency ratios focus on long-term debt, while profitability ratios focus on earnings. Next important short question is valuation ratios. Valuation ratios are financial metrics that help assess the value of a company, often used by investors. Common valuation ratios include 1. Price to earnings. PE ratio measures the company's stock price relative to its earnings. For example, if a company's stock price is $50 and earnings per share (EPS) is $5, the PE ratio is 10, $50 divided by $5. 2. Price to book (PB) ratio compares the market value of a company's stock to its book value. For example, if the market value is $1 million and the book value is $500,000, the PB ratio is 2. In short, valuation ratios help investors determine if a company is over or undervalued. Next important short question is DuPont chart. The DuPont chart is a financial tool used to break down a company's return on equity, ROE, into 3 key components: profit margin, asset turnover, and equity multiplier. This helps understand what drives a company's profitability. For example, if a company has profit margin is equal to 10%, asset turnover is equal to 2 times equity multiplier is equal to 3, the ROE would be ROE is equal to profit margin times asset turnover times equity multiplier is equal to 10% times 2 times 3 is equal to 60%. In short, the DuPont chart helps identify areas for improving a company's return by breaking down the components of ROE. Next important short question is ICAI. ICAI stands for the Institute of Chartered Accountants of India. It is the national professional accounting body responsible for regulating and promoting the accounting profession in India. It sets standards for accounting, auditing, and ethical practices. For example, ICAI provides certification to individuals who pass exams and meet requirements to become chartered accountants, CAS. They also offer training, resources, and updates on accounting standards. In short, ICAI plays a crucial role in ensuring the integrity and professionalism of accountants in India, guiding their practice and development. Next important short question is IND-AS stands for Indian Accounting Standards, which are a set of accounting rules and guidelines that companies in India must follow when preparing their financial statements. These standards are similar to IFRS, International Financial Reporting Standards, to ensure consistency and transparency in financial reporting. For example, under IND-AS, a company must report its revenue when it is earned, not when the payment is received, following the accrual method. In short, IND-AS ensures that companies in India follow standardized, transparent accounting practices for accurate financial reporting, making it easier for investors and regulators to understand. Next important short question is IFRS stands for International Financial Reporting Standards. These are global accounting rules that companies use to prepare their financial statements. The goal of IFRS is to make financial reports more consistent and comparable across countries. For example, under IFRS, a company must recognize revenue when it is earned, not when cash is received, ensuring consistency in reporting. In short, IFRS ensures that businesses worldwide follow the same accounting rules, making financial statements clear and comparable, which helps investors, regulators, and other stakeholders make informed decisions. Next important short question is PE ratio. The PE ratio, price to earnings ratio, is a measure used to value a company. It compares the company's current share price to its earnings per share, EPS. The formula is PE ratio is equal to share price divided by earnings per share, EPS. For example, if a company's share price is $50 and its EPS is $5, the PE ratio would be 10, $50 divided by $5. In short, the PE ratio helps investors assess if a stock is over or undervalued compared to its earnings. A higher PE might suggest the stock is overvalued, while a lower PE could indicate undervaluation. Next important short question is accounting standard. Accounting standards are rules that guide how businesses should prepare and present their financial statements. These standards ensure consistency, transparency, and comparability of financial reports. For example, as 1, disclosure of accounting policies requires companies to disclose the accounting methods they use, like how they value inventory or depreciation. In short, accounting standards set the framework for how financial transactions should be recorded and reported, making it easier for investors and others to understand and compare the financial health of different businesses. I hope you understand easily each question. All the best, students, for your upcoming exam. For other subject quick revision. Important questions. Previous question papers. And syllabus. Links are available in description. Check out once. Thank you for watching. Like and share this video with your friends.